In the last 3 months, Europe has liquidated $10 trillion worth of American financial exposure. That is not a forecast. That is the confirmed number. And the catalog of dumps is absolutely brutal for Wall Street. Sweden's AP7 pension fund, gone. 8.8 billion of US Treasuries sold. Alecta, another Swedish giant, gone. Majority of $11 billion American bond book liquidated. Denmark's academic fund, gone. Teachers fund, gone. Finland's Veritas, gone. Japan's pension giant, the biggest on the planet, slashed US Treasury holdings from 47% down to 35% and rotated straight into European sovereigns. The dollar crashed 10% in 12 months to a 4-year low. Gold nearly doubled to $5,500 an ounce. Bank of America now estimates European investors need $2.5 trillion of currency hedges just to neutralize remaining US exposure, which itself pushes the dollar lower. And today, Italy's UniCredit sits 1 percentage point away from forcing the biggest European banking takeover in a decade, $35 billion. Every euro staying inside EU borders. Germany's Commerzbank rejected the deal publicly, but UniCredit already controls 29% of the shares. The block is mathematical. The rejection is theater. Meanwhile, American firms are buying up everything they can on the European side. Schroders sold to Nuveen, 99% shareholder approval, NN investment absorbed by Goldman Sachs, Insight investment swallowed by BNY, two opposite flows, same moment. Winner takes European capital for the next generation. I'm Mike. Let me show you what's really happening. Nothing here is financial advice. Let's start with the real scale because the $10 trillion number actually understates the exposure. Fresh data from the Voronoi database shows European investors were sitting on $14.5 trillion of US financial assets at the end of 2024. That breaks down into $8.93 trillion in American corporate stocks, $2.93 trillion in Treasury and agency securities, and $2.64 trillion in corporate bonds. Meanwhile, US investors only held $5.39 trillion of European assets, so Europe has been sending roughly $9 trillion net into American markets every year of accumulated flow. That is enormous positive carry for the United States, and it is the exposure European pension boards are now systematically unwinding. On the asset management side, a Brussels think tank called Bruegel dropped a policy brief on April 8th that put an even sharper point on the problem. American firms now run 47% of European asset management, up from 40% in 2021. North American firms globally grew their share from 73% to 78% over the same window. European firms, meaning EU, UK, and Swiss combined, dropped from 21% down to 17%. The Bruegel fellow behind the paper, Dirk Schoenmaker, summed it up for policymakers in Brussels. Asset owners in Europe have to take responsibility for the managers they keep handing mandates to. If European pension funds keep defaulting to Wall Street firms, there will not be any European asset managers left tomorrow. You can see the panic response showing up in flow data already. In January alone, European equity funds pulled in $26.5 billion of inflows, most of it through ETFs. European money market funds lost $17 billion over the same period as savers rotated out of cash and into actual European risk assets. That is household money moving inside European borders after years of chasing returns in American ETFs. The rotation is active, it is measurable, and it is accelerating. Now let me go deeper on the UniCredit Commerzbank play because the mechanics are fascinating and the political theater is obscuring where this is actually going. Italy's UniCredit formalized the $35 billion bid on March 16th, the biggest European banking consolidation attempt in more than a decade. Commerzbank's CEO Bettina Orlopp went on Bloomberg TV earlier this week and said the two banks remain far apart on valuation and the exchange ratio. Formal rejection. But here is what the rejection does not stop. UniCredit already holds 29% of Commerzbank through a combination of direct equity and derivative contracts. Under German rules, crossing 30% triggers a mandatory full takeover offer. UniCredit has already asked regulators to authorize up to 470 million new share issuances, specifically to fund the acquisition. And Commerzbank's own share price has fallen 16% over the 4 weeks leading into April, which mechanically makes UniCredit's exchange offer more attractive to the same shareholders Orlopp claims to protect. The longer the Berlin establishment tries to block this, the better UniCredit's position gets. Why does UniCredit even want it? Because the strategic logic has completely flipped from where European banks were pointing in the 2010s. The old dream was American footprints, investment banking desks in New York, retail networks in the States, dollar-denominated expansion. That dream died. European banks, especially mid-sized ones with less than $100 billion in assets, are now closing U.S. operations because the compliance costs of running two regulatory systems in parallel eat the margin alive. A pan-European banking champion that can fund European industrial policy, European defense procurement, and European energy transition without routing capital through Wall Street is the new thesis. That is what UniCredit Commerzbank becomes if the deal closes. European private equity is running the identical trade. Firms like CVC and EQT are putting 60% to 70% of new fund capital into European mid-market infrastructure, energy security, and decarbonization projects. American buyout markets are saturated, entry multiples are stretched, and hedging dollar exposure now costs real money as the dollar weakens. Deploying at home removes every one of those drags at once. Secondary market transactions and continuation vehicles keep ownership inside the continent rather than exiting through American public markets. Now, the ESG wedge, which is the piece that makes this whole realignment structural rather than cyclical. European pension funds in the Netherlands and Scandinavia operate under strict EU climate disclosure rules by law. Texas, Florida, and West Virginia have passed anti-ESG statutes that actively penalize investors for applying climate or social criteria to allocation decisions. A Dutch pension fund legally cannot hold positions in American private equity vehicles operating under those anti-ESG state frameworks without violating its own regulatory obligations back home. Analysts estimate the incompatibility could trigger up to $40 billion of stock divestments as European funds rebalance to stay compliant. And this is not something that resolves on the next business cycle. Brussels would have to loosen its climate disclosure rules, or Austin would have to repeal its anti-ESG statutes. Neither is anywhere close to happening. There is also a demographic timer running underneath all of this. The European Commission has warned that 600,000 European businesses change ownership every single year, with roughly 1 in 3 facing succession stress because the owners cannot find European buyers. In Germany alone, 626,000 small and medium enterprises are scheduled for ownership transfer over the next 2 years. That is 16% of the entire German Mittelstand, the industrial backbone of the Eurozone. If European capital is not available to fund those successions, American private equity will buy them at scale, exactly as happened when U.S. holdings of European business assets tripled from $1.05 trillion to $379 trillion between 2011 and 2024. The policy window to stop that trajectory is right now. Let me talk about what triggered the timing of all this. The Trump administration did not invent the underlying trend, but it absolutely detonated the timeline. The Greenland standoff in January produced what Wall Street analysts labeled the Sell America trade, when the White House threatened 10% tariffs scaling to 25% on 8 European nations unless they supported a Greenland transfer. The Bloomberg Dollar Spot Index sank to a 3-week low. That is normal. What made the signal unusual was that dollar weakness hit at the same time as rising US Treasury yields. Normally, geopolitical stress drives money into treasuries. Yields drop. Dollar strengthens. This time, the opposite happened. Both the dollar and Treasury prices fell together. That is the configuration that breaks the flight to safety pattern that anchored American markets for half a century. And here is where the Besant Davos moment becomes the arrogant misread of 2026. Treasury Secretary Scott Bessent stood on the Davos stage and dismissed European Treasury divestment with a line about Denmark, like its investment, being irrelevant because the Danish fund was only $100 million. The number was technically accurate on that one position, but Denmark holds $782 billion in total pension assets. Roughly 26% of that sits in the United States. Multiply that exposure ratio across the Netherlands, Sweden, Norway, Germany, France, and Finland, and the aggregate exposure stops being dismissible very fast. Every pension dump we open this video with is running that exact math. On the asset manager side, the consensus is striking because it actually crosses Atlantic lines. Amundi's group CIO Vincent Mortier framed the 2026 strategy as a barbell, and his exact line was that the goal is not to change horses but to reduce dependence on a single horse. That is diplomatic language for cutting American concentration risk. Amundi's CEO Valerie Baudson confirmed publicly in February that the firm, which runs $2.4 trillion, is reducing dollar exposure and redirecting into European and emerging market assets. But this is not just Amundi. PIMCO, which is an American bond manager, has said publicly that unpredictable policy decisions are fueling multi-year diversification away from U.S. assets. Natasha Brooke Walters at Wellington Management is running her $70 billion multi-asset book by rotating into euros and Australian dollars. Becky Chin at Fidelity International has meaningfully cut dollar exposure across her $7 billion portfolio. Even California's state teachers' retirement system, which is a large American pension, is publicly reconsidering its U.S. heavy allocation. When Amundi, PIMCO, Wellington, Fidelity, and CalSTRS all arrive at the same positioning conclusion independently, you are looking at institutional consensus, not a contrarian bet. Now, the structural implications for American markets. America runs a net international investment position deficit of $27.61 trillion. That is the gap between what foreigners own in American assets versus what Americans own abroad, and the model requires continuous foreign capital inflows to sustain it. When European pensions, European asset managers, European private equity, and Japanese pension funds all reduce American exposure simultaneously, buyers disappear from Treasury auctions. Yields have to rise to clear the same amount of issuance. Corporate borrowing costs follow. Equity multiples compress. None of that happens in a single session. It plays out over quarters, and the longer the flow persists, the harder the repricing gets. Here's what I would watch for through 2026 and 2027. First, more European banking mergers following the UniCredit template, cross-border deals staying inside the EU rather than seeking American partners or New York listings. Second, pension funds continuing to trim US Treasury exposure, especially if Washington keeps widening fiscal deficits. The Danish fund CIO Anders Schelde already put the framing on record. Poor American government finances is the driver, which is a structural concept, not a political one. Third, European private equity avoiding American exits entirely, using continuation vehicles and European-to-European transactions to keep ownership local. Fourth, the ESG regulatory wedge widening further. Fifth, the dollar staying under pressure because the hedging mechanics feed on themselves once the flow starts. I want to be fair to the full picture, though. Europe is not abandoning the United States wholesale. Danish pension investments in American equities generated $89 billion in returns since 2018. Compared to only $15 billion from European equities over the same period. Complete divestment would hurt European retirees. The objective is not exit. The objective is pulling back from dangerous concentration and doing it before American policy volatility forces a disorderly move. When a dominant financial market becomes institutionally unpredictable, threatening allies over territory, weaponizing trade policy, criminalizing investment criteria, capital eventually seeks stability elsewhere. What Europe is doing is risk management, not political retaliation. Pension board members have fiduciary obligations to beneficiaries. They are legally required to protect retirement savings from unpredictable jurisdictions. That is different from political sentiment, and conflating the two is the mistake American officials like Besant keep making. All of this connects directly to the wider European realignment architecture. Prime Minister Carney building Canada-Europe defense partnerships. Von der Leyen moving to end EU veto power so Europe can act faster as a unified bloc. Finland welcoming Canada toward EU membership discussions. Meloni choosing the Pope over Trump on Ukraine peace framing. The capital divestment story is not separate from the political realignment story. Capital autonomy is the financial infrastructure that makes every other piece of strategic autonomy possible. You cannot fund European defense expansion, European industrial policy, European energy transition, or European succession absorption if the capital stack depends on American intermediation. Europeans have finally figured this out, and every institutional actor across the continent is now executing variations of the same play. The full playlist tracking all of this is linked in the description. Every video connects to the others: institutional reforms, defense build-outs, diplomatic breaks with Washington, and now capital reallocation. These are chapters in one transformation. For a direct example of how the political side is moving in parallel, check the video on your screen right now covering von der Leyen ending the EU veto. The capital flows and the institutional reforms reinforce each other. Europe is cutting dependence on systems it can no longer rely on, and it is doing it faster than Washington realizes. Thanks for watching. Subscribe if you haven't, and I'll see you on the next one.